Joining me now, Rebecca Walzer, CEO of Walzer Wealth Management. Rebecca, always great to have you.
Thank you. So great to be here. I love being here.
We love when you join us here. So let's talk about your view of the market right now. Seems maybe a little bit uneasy, a little bit confused. We have stronger economic data, but why are investors uneasy about that?
I think that it is a realization that AI is actually going to impact jobs. We saw Amazon announcing some of their largest layoffs ever. And I think that investors have been and last year was almost like just the fairy tale land of, AI is going to just create this massive ability of efficiency. And there wasn't really a consternation of, yes, but what does that mean to human capital contribution to GDP? Is that not going to be affected? And I think now investors are starting to get more savvy and starting to realize, AI is actually going to impact human capital. It is going to actually mean that we can have more efficiencies with computer algorithms and not an actual human. And that is starting to make investors say, well, how does this really impact my job, my industry, the fundamentals of actually investing? This is a completely new industrial revolution. This is what we call creative destruction, which is what capitalism is. There's always going to be a new way, a better way, and that destruction destroys the old ways of doing things and prepares for the new ways. And I think that's what investors are finally starting to get in 2026. Wow, this is creative destruction, and it does mean changes for the status quo.
But let me ask, is the rotation that we've been seeing out of software and financials, is that warranted then, or do you think it's overblown at this point, especially with software?
It is absolutely overblown at this point, but it is true. It is going to come to fruition eventually. But I do believe that investors are finally just waking up to saying, wait a minute. And they're starting to get nervous and they're starting to execute, sell decisions. We're definitely in an oversold position on software, without a doubt.
So which parts of software and financials would you be comfortable owning or scooping up right now?
I really love the software that is going to integrate an open AI component or an AI component. I am saying open AI, but I'm thinking of like Intuit, for example. They have a suite of products, Credit Karma, QuickBooks, obviously TurboTax. And they have a partnership now, a strategic partnership with OpenAI. So they're recognizing, listen, our software is valuable. I can't tell you how many middle-sized businesses use QuickBooks as their go-to. So, a lot of Americans use TurboTax every single year. So it is a necessary software, very technical software, but it has to come with an AI component. So if you've got a software, it reminds me on the financial side of Visa. Visa has done massive strides to make sure that their ability to payment process is going to be able to be done on the blockchain. And so when you see a company that is traditional finance moving into the de-finance world and making those strides to be on the blockchain, then you can say, okay, I feel confident that this company could be a viable player as we move into the fourth industrial revolution. The companies that are not doing that, they are rightfully being sold and they will get left behind.
So given the uncertainty, the volatility, the disruption that we're seeing in AI, how are you actually positioning your portfolios at this point? Are you leaning into opportunities in AI? Are you more defensive at this point?
It's a great question. So I feel like we have definitely looked and we have pared down. We obviously believe in commodities. We've been big gold and silver bugs really since the pandemic in 2020, and the world started closing down and stimulating. We knew that meant massive currency inflation, and so we've been big gold and silver hedge believers since 2020. However, what we saw with Venezuela, with the tension in the Middle East, with the Iranian conflict that has really come to fruition, we saw, hey, you know what? We think a rotation into energy, especially with all the data centers that are coming online, is really going to be a great 2-year play. So we kind of pared down some of our silver holdings at sort of the top of the market since August. We've kind of been taking profits and moving into and rotating into energy. And we feel like that is going to be, for the next 2 years, a really solid play. So we are looking both at the long term. On the long term, we're going to say to our clients, listen, we have a fourth industrial revolution frontier fund that specializes in the 4 technologies of the fourth industrial revolution, which if you don't know what those are, we're looking at specifically AI, robotics, quantum computing, and the blockchain, all things the blockchain. But that is very volatile and very speculative, and that's going to be a long-term play. You're going to buy in now when it's not really sure where it's going, and we're going to hold that for a long time. But that's very risk-on. You have to be very comfortable with it going up and down and gyrating, because this is the monetization stage of this fourth industrial revolution, which is always choppy and always volatile. Just remember back to .com. That was a disaster, but you have to stay with it. So we would say on the long term, you want to position yourself for these frontier technologies, understanding the volatility comes with it, and short-term look at more of the immediate opportunities that are happening both geopolitically and because of these transitions that you can capitalize on more short-term.
So aside from more volatility ahead, what is your actual market forecast for this year? Do you think this is a market that ultimately will end the year higher?
We started off on January 2nd basically telling our clients that we saw at least a 5 to 10% pullback in Q1 because of all of these things that are happening. That could continue into Q2. So we're not really expecting super positive upside, but we do start to see a turnaround in Q3 and Q4, especially once we get past like the midterms, we can see a positive upside. So we do overall think that this market could raise, but we're not talking about a 10 or 20% raise like we've been kind of getting used to. Like it's normal. It's not normal, people. 5% at least, 5 to 7%, we think the market could end up higher, but it's going to gyrate these next 2 quarters, and it's going to be scary, and investors might be alarmed.
So what's on your shopping list for when we do, or if and when we do see the market pull back? What do you want to buy in terms of dips?
I mean, I am definitely buying some of these software dips because I think it's an oversold position and they have been really routed too aggressively. It's the fear factor, right? It's this behavioral selling that, you know, the crowd. If you're a part of the crowd, you're probably wrong. You need to be the outlier, the contrarian, and doing things either preemptively ahead of time, like we were been paring back metals since August and moving into energy, or you need to just be, you know, sometimes just do nothing. Like if you start to see all the software is being sold, you know, let's just do nothing. Like Intuit, for example, it's 50% off its all-time high. We believe that's a good buy long-term. They are really low on their price earnings ratio, under industry 19.6% versus 26% is the standard. So we are appreciative of these long-term ability to make some money, but you cannot follow the crowd. The crowd is usually wrong.
Okay. Best advice for investors as we think about some of the choppiness that we could encounter and a lot of these AI headlines that continue to dominate?
Ask yourself what you're willing to put at risk. There's no return without risk. So we know that you have to risk something. But if you're not able to risk 50% of your portfolio and risk on in this kind of choppy environment, this kind of geopolitical midterm election year environment, then pare back your risk on and move to something that's more stable if that's what's comfortable for you. But just understand that it is going to take you buying in to risk and holding that risk for a long term. We're talking probably 60-month, 5-year window before we'll really see some stabilization of the new frontier. And the new frontier is here. It is disruptive. It is going to destroy old ways of doing things and create new ways of doing things. And you need to be a part of that from the very beginning.
Okay. We'll leave it there, but before we let you go, we have our rapid fire this or that.
Yes!
You've done this before with
Love
us.
it.
Are you ready to do it again?
I'm ready.
All right, here we go. Market vibe, healthy rotation or slow motion breakdown?
Ooh, gosh, these are always so hard. It's a mix, right? It's definitely a healthy rotation because we definitely know that there's destruction happening, but also it's overhyped and investors are getting ahead of their skis. So I think it's both.
Outcome, soft landing dream or hard recession reality?
Ooh, now we're talking about currencies and fiat currencies and stable coins and all of those things. So I think eventually we're looking at the end of the fiat currency system as we know it, the beginning of the end of the fiat currency system as we know it. It's going to be a longer term play, but it is the beginning of the end of something that has been the norm since 1944.
Fed's next move, another cut or hold?
The jobs report coming in so strong, really, diminished our prospects of a lot of rate cuts. But we do get a new chair, obviously Warsh in May. So I think that he is going to set the tone, and we will see what his consensus that he can build. We'll see what it is.
Volatility, trade it or stay on the sidelines?
You got to be in. You got to be into risk. You just got to accept how much volatility you can take.
Buying the dip, smart move or too risky right now?
On some software, smart move, absolutely.
Financials, AI threat is a real danger or totally overblown?
It is somewhat overblown for the immediate term. Is it a real threat? Absolutely. Long term? Absolutely. We will be doing things differently on the financial side. We're talking 5 years from now, we won't even recognize what financials look like.
Something we haven't talked about, small caps, the ultimate value play or the classic value trap?
Small caps really need really low and cheap credit, and we might not get as much of that as we think we are deserving of. So I am not if I had to say one way or the other, I wouldn't be a big play fan on small caps.
Better buy big tech or consumer staples?
Recessionary consumer staples are always a solid if you're not into risk volatility, but you have to be on the frontier to be participating in what's coming.
Better safe haven. Gold at 5,000, Bitcoin at 67,000.
Always gold. Always.
Yields, cash or long-term treasuries?
Ooh. Oh gosh. I'm gonna, oh gosh, oh man. I mean, I have such a hard time because I see the currency rotation out of fiat is happening as we speak. So I'm gonna say cash.
Market structure, equal weight, S&P or Mag 7?
I'm gonna go with equal weight. I think we can broaden out and we can be beyond the Mag 7, and we need to be. We need to be beyond the Mag 7.
Okay, but that note, strongest Mag 7 name right now?
Amazon.
One stock to own for the rest of the year?
Golly, you give me the hardest questions. I can't even do this. My goodness. Oh my gosh. I'll pick Amazon. It's easy. It's safe.
One stock to avoid?
One stock to avoid. Bank of America?
Most misunderstood asset?
Maybe Bitcoin.
Okay, we'll leave it there. Rebecca Walzer, always a pleasure. Thanks so
Thank you so much.
That was Rebecca Walzer, CEO of Walzer Wealth Management.